With the S&P 500 trading near all-time high, there's many amazing quality companies trading near their 52-week low. And in this video, I'm gonna discuss two of those amazing high-quality stocks trading near their 52-week low. And this is a screener that I go through pretty much every single weekend. You can go on any screener, and I go on Fiscal.AI, and I just type in profitable stocks trading 10% within their low. And I look at 52-week low stocks pretty much every single weekend. And sometimes you could find a lot of amazing opportunities whenever you're looking into such stocks. And I've been finding a lot of them, especially whenever you have a massive run up in the markets. Normally, for example, the money would go into a lot of tech stocks, into a lot of Big Seven. It would come out of a lot of boring stocks like the healthcare stocks, like Copart, like utility stocks. But then a few months from now, when no one really wants tech stocks anymore, which is a cycle, people will love healthcare again. They would love the utility stocks. They would love the recession-proof stocks that they were dying to own back in April. No one wanted tech stocks in April. They wanted the recession-proof stocks. Now, no one wants them anymore, which is why there's many amazing opportunities amongst very boring companies trading near 52-week lows. I'm going to talk about two of them today, and I'm going to try to make one video every Saturday about stocks near 52-week lows. And if this is something that you want to see, please let me know down in the comments below. And this is the first one of the most popular company in the world, and this is Warren Buffett's Berkshire Hathaway. The stock is down 12% from its all-time high after Warren Buffett has announced his retirement, and he's gonna be stepping down pretty much at the end of the year of 2025, and it's gonna change a lot of things at Berkshire Hathaway. A lot of people say it's for the good, a lot of people say it's for the bad, but most of you know how Berkshire Hathaway makes money. They own many different businesses, hundreds of businesses. The largest one is the insurance business, which is Geico, and other reinsurance kind of businesses. They make $25 billion in revenues from the insurance business. Then they have the railroad, which is BNSF. They make $5.7 billion from BNSF. Then I have Berkshire Hathaway Energy, which is a very resilient recurring revenue business model. This one is $6.4 billion. Then I have like $10.4 from their pilot kind of business, $18.8 billion from manufacturing. They own a lot of different manufacturing brands. They own Michelin within the trucking and shipping, $12.2 billion, and other kind of services and retailing, NetJets and others, and See's Candies, where they make around $10 billion. And this is the company Berkshire Hathaway. And of course, they have a stock portfolio like Apple, American Express, Bank of America, Coke, and many different companies within their stock portfolio. Okay, now the main investment thesis, and I have a different thesis from most investors on Berkshire, but the main investment thesis is that if you look at Berkshire's cash position, Berkshire has an amazing cash position relative to its market cap. So its market cap right now is around $1 trillion, so pretty much $1 trillion. So out of the $1 trillion, you're getting $347 billion in cash and cash equivalent. So this is almost 30% of the market cap to 35% is in pretty much cash. So this is too cheap to ignore. And if they do deploy this cash, it's going to be amazing for the company. Now, my only concern with Berkshire Hathaway is where are they going to put this money? Now they're putting it in T-bills. They're correcting 4.5%, 5% on short-term treasuries. What's going to happen when interest rates come down? Where will Berkshire Hathaway put a $347 billion cash position? They already have an insurance business. If they acquire another insurance company, it's going to trigger a monopoly. They're not going to let it pass through in terms of the regulations. It's not going to pass. If they want to acquire another railroad, they can't. They have BNSF. It will be a monopoly. They cannot acquire another railroad. If they want to acquire more energy assets, that's also going to be very hard. It's going to trigger some kind of a monopoly. So the company is going to have a very hard time acquiring whole companies in the United States because they have so many businesses in so many key sectors where if they acquire another one of those, it's gonna be very hard to pass it through the regulators and to convince them that it's not gonna trigger a monopoly or some kind of a major status that could potentially hurt consumers or monopolize their pricing. So that would be very hard to pass in the United States. But they also own the three trading houses in Japan. So the three or four biggest companies in Japan, they already own them. So they can't really invest in Japan to move the needle. So where are they going to put the 347 billion? And the truth is, I don't know. This is the biggest mystery with Berkshire Hathaway, is everyone is looking at the cash position, and if they invested and they do this, what are they going to do with the cash position? I mean, there's only so many stocks they can invest in that they don't already have a 10% ownership. They already have Coke, they already have American Express. Even Greg, the new CEO, which he's coming in 2026, he's not going to be putting in, let's say, 10% in Microsoft at 35 PE. I don't think so. This is not the company's strategy. So which companies is he going to buy? Meta at 28 times earnings? I highly doubt it. I mean, I would be very surprised. So I'm not really seeing how the company is going to deploy its 347 billion. And once interest rates come down, I think they're going to have a hard time. Maybe they can deploy some of it in Canada, some of it in other places, but it's going to be very hard to deploy the cash position. Now, Monish Pabrai, which is very close to Greg, very close to Buffett and Munger, which he passed away, unfortunately, he knows them very well. And he recently commented on Greg Abel, the upcoming CEO, and he said Greg is more hands-on. He likes to find synergies between this company and this company. Buffett kind of lets them run their own kind of businesses, but Greg is more hands-on. He wants to find synergies, cut a lot of management here and cut a few expenses there. So he's more hands-on, and there will likely be more efficiencies. He also said that Greg is much more willing to take risks than Warren Buffett in terms of investing large amounts of money. So we might see more risk taking at Berkshire Hathaway in 2026 after Warren Buffett, retires from being a CEO. So to me, it's an amazing company, and they have a lot of cash, of course, and it's amazing, but I'm not sure what they're going to do with it. They do have a buyback program. They've been buying back like 1.5% of shares outstanding, and they can do that. But again, that's really, once they do the buybacks, and what's they going to do after? So to me, I'm not really seeing the benefits of this cash position. It's going to be very hard to reinvest it, which is why I'm not dying to own Berkshire Hathaway. I think Berkshire Hathaway is a buy at the right price, but this price is not now. That's how I look at it. So for Berkshire Hathaway, it's a very hard company to value. I would look at it at a price to book value multiple. The average price to book value for the company has been 1.4 times. So historically speaking, if you paid 1.4 times or below, it has been a good time to be buying Berkshire Hathaway. So I'm going to value it at 1.4 times to play it safe, as now we don't have Warren Buffett. We have a large cash position, and it's not as easy to deploy it. So we want some margin of safety, not just through the cash position, but also through the company's valuation itself. Now, if we look at the company's balance sheet, they have their shareholders' equity of 656 billion, which is what is used to calculate book value. We use stockholders' equity, or you could say shareholders' equity. Now, as we talked about, the average is 1.4 times for price to book value. So we're going to take in the 656 billion, 742, and we're going to times that by 1.4 price to book value per share. We get around $919 billion market cap. Now, Berkshire's B shares outstanding are a decent amount. So we're going to divide the total market cap by the total amount of shares, and the total would be around $426 per share. So for me, Berkshire Hathaway is a buy around $430 per share or below, which would be around 10% more on the downside from here. So this is a price where I would be willing to take the risk on Berkshire Hathaway of the company potentially not being able to invest the cash position efficiently, of maybe not collecting as much interest when interest rates come down. Now it's easy, they buy T-bills. What is they going to do after when interest rates come down? So for me, I want some more margin of safety, and I'm willing to pay the average book value per share, which is around 1.4 times, which would equate a share price of around $426 to $430 per share. So I have a price alert of $430. If it triggers on Berkshire, I might decide to buy the stock. If it doesn't, then I think there's way better opportunities in the stock market today. And this is the second one, very popular one, and it's FICO. FICO is down 22% year to date. And this is a testament to what I really talk about on this channel, which is mainly not just about a company being a quality company, but also the price we pay for this company. I mean, this is one of the widest moat, best companies you could own in the entire stock market, and it's underperforming pretty much any stock year to date and over the last year. But if you look at the company's valuation, it was valued at 80 times forward earnings, guys. 80 times. There's no way you could justify 80 times. Although I've seen even back then posts on X of people justifying why it deserves to trade at 80 times because it's a quality company. So the lesson is that not every stock is the next Costco. So we all look at Costco as a model and we say, oh, Costco is trading at 50 times, so this company could sustain 50 or 60 times. Not every company is going to command the Costco valuation, and it's not going to sustain itself forever, which is why it's important to pay the right price for those companies. But most of you guys know FICO. They have the credit scores in the United States where if you want to apply for a loan, apply for a mortgage, to buy a house, they would check your FICO score, your credit history, to make sure you have paid on time, you don't have any missed payments. And this is the agency that controls that score. And they pretty much have a monopoly. They raise the price every single year, and they do extremely well. One of the just high margin, amazing company. Most of it comes from scores in terms of their revenue mix. Then they have a tiny portion from what they call professional services, and then they have 183 million from software as a service, which isn't growing, but it's pretty much recurring revenue. But the growth has been, of course, happening in the scores business as they can raise the prices every single year. Now, something very recently has happened, something very interesting, and the Federal Housing Finance Agency director, he has announced that lenders may start using VantageScore as a rival to Fair Isaac Corporation, which is FICO, to assess the credit worthiness of the buyers. So prior to this announcement, if you want to go to apply to buy a house, you want to apply for a mortgage, they would check your FICO score. Now the lenders have the option to check your Vantage score, which is a new competitor to a FICO score. Now this could be a big deal because it would lessen the business model of FICO and their pricing power. But some other analysts, they have another opinion on that. And he said, we have trouble seeing lenders abandoning FICO just because they are now able to use VantageScore. And he said that this is because lenders have very little experience using Vantage scores when it comes to mortgages. So they're pretty much used to using FICO for all those years. They're not going to just switch to Vantage just because Vantage is available. Vantage would have to offer something much cheaper than FICO, some kind of a major advantage for them to start using Vantage. Otherwise, even though Vantage is available, they're still going to use FICO. The same way, let's say Google is available and Bing is available. Even though Bing is a good product, people have been using Google for many decades, and they're going to continue to use Google. It's the same thing with FICO and the Vantage score. Okay. Now, for the company's earnings per share, it has been growing rapidly. The earnings per share, especially over the last 3 years, 20%. As of September, which is this year, is going to end in a few months. This year is going to be a 40% growth year in earnings per share. For FICO, next year is expected to be 24%. Now, for my valuation model, I used this year's number of earnings per share, which is $29.30. So I put in $29.30. Then I used 20%, 20%, then 15%, as I believe the company will likely decelerate in growth over time. Previously, it has been growing 25, 30, 40%. I'm taking it down to 20 and then to 15, which is it's hard to estimate the growth potential of such companies, but I personally believe this will likely be nearly accurate in terms of the estimates. The current PE is 47 times earnings. Again, I still believe that this is ridiculous for a company like FICO. And for FICO, I would personally, pay something around the average. The average is like 35 times earnings. I think that would be a good multiple to pay for a company like FICO. So I put in 35 times earnings, especially if the growth decelerates in the future, you have to lower the multiple. So using 35 times earnings and no dividend for now, I would get 52% on the upside or 8.7% CAGR, which is an 8.7% annual return for the next 5 years, which is pretty much nothing with the company. Now, in this case, if I want to double my money with FICO over the next 5 years, I would have to buy FICO around $1,172. So this is another company that looks attractive. It's a quality company, and we get the tendency to want to buy the dip on the stock. But for me personally, using my valuation model, it doesn't look as attractive as it does on the charts that this is a discount and we should rush to buy it. So I have again a price alert at 1170, 1200. If it gets to this price, then I believe I would be paying a fair price for the company. But if you're really dying to own FICO, I mean, maybe they're gonna grow 20%. So if we change it to 20% and they grow, 20% forever, then the valuation would be a little bit better, and you could pay up to $1,300 to get a double on FICO. So it's really not the worst investment in this market for FICO and Berkshire, but I believe, they have to go down a little bit more for me personally to get attracted to them. And this is my opinion on FICO and Berkshire Hathaway. Not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.